This is Matt Godleski with CapTrust Advisors bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks pull back on inflation and Fed concerns as speculative investments like cryptocurrencies take a hit and a flight to safety boosts treasuries and gold. Equity markets traded lower this week as investors continue to grow cautious over the prospect of rising inflation. Significant volatility was seen in the riskiest areas of financial markets. Cryptocurrencies and companies with little or no profits sold off. Losses were concentrated in technology firms that are reliant on strong growth in the future to justify their current prices. In a sign of the risk-off mood, investors flocked to treasuries and gold for their perceived safety. On the economic front, jobless claims declined to a new pandemic low and have now fallen more than 50% since the first week of the year. Earnings calls for major retailers have reported strong sales in clothing, cosmetics, and even teeth whiteners, signaling consumers are emerging from last year's hibernation, boosting confidence in growth ahead. The economic and financial market environment continues to be favorable, with growth stronger than we've seen in 60 years. Consumers are in the best shape in a generation, and corporate balance sheets are also showing resilience. Meanwhile, the Fed remains on hold for now, though cracks may be forming in their resolve. If inflation continues to surprise to the upside, the Fed may have to reduce their bond purchases and raise rates sooner than anticipated. As seen in past recessions, a misstep by the Fed could unnerve investors and lead to the next downturn. The Fed is adamant with their stance that inflation is temporary and will slow in coming quarters. Sustained higher prices would likely force their hand to take action sooner than anticipated. Strength in input costs like copper and lumber, as well as supply bottlenecks, continue to plague production processes. The specter of inflation has continued to be debated on Wall Street, with last week's consumer price data setting a dire tone for some. One issue we continue to evaluate is the stability that bonds can provide for allocations to offset stock market risk. Recently, bonds have not been working like the safe havens they used to. Correlations between equity markets and treasuries are at the highest level since 1999, as both asset classes move more in tandem. The main culprit behind the change is likely inflation, as bonds may no longer provide the same diversification benefit. That dynamic has made us reassess the role of fixed income in portfolios. We have increased the prominence of alternatives and dividend income-oriented securities as a solution. Where markets stand today, we've made no major adjustments to portfolio allocations as we are confident in the current balance. We believe that the best opportunities remain with equities. Specific sectors like financials, select European markets, and other cyclicals present the best near-term value in our view. Looking out further, technology and healthcare remain our top picks for secular winners. Thanks for watching, and please feel free to call our office with any questions you may have.